Welcome everyone. We are now going to step through the PowerPoint slide deck for Chapter 3. Hopefully this will reinforce the theory that the authors present in the textbook, and then it will make the problem that we go over make that much more sense to you. So let's get moving here on these slides and see what we're up against with the concept of doing a consolidation after the point in time when you bought the subsidiary. Now, maybe 1, 2, 3 years have passed, and what happens. So, and obviously there are some complexities that are created as that happens. You have dividend transactions from subsidiary to parent. You can have all the intercompany transactions that we're going to get into more detail in chapters 4, 5, and 6. So that's something we'll have to deal with. And of course, the worksheet consolidation entries are used for that elimination of the investment. That's really step one, is to get that reduced down to zero. And then we've got to adjust the assets and liabilities to get to this concept of a single reporting entity of two or more entities bringing together in a consolidation. So this stuff should be familiar from your reading. And so let's keep moving here. And for each subsidiary owned, and obviously it's in the real world, you can have dozens or scores of subsidiaries that one parent owns. So for each one, you're going to have a separate asset account. And if you're on the equity method, you'll have an income account to record the earnings on that investment. Now, if we're going to see in a little bit that if there's a dividend transaction, that parent will have just a dividend income as if maybe a completely separate company, that is not part of their consolidated group, had paid them dividends. It'd be the same manner in which they would record that income. But we're going to see that it differs between the initial value method and the equity method later. And so that is how we'll set up this next bullet listing. Is you have three methods of choice in recording on an ongoing basis the investment you have in these subsidiary entities. Now, the first one you're very familiar with from Chapter 1, which is the equity method. So you just keep making those same entries on your books. Okay, this is, as a dividend transaction occurs, you're going to be making that entry on the general ledger. And then you have the initial value method, also called the cost method. That's what I'm used to calling it in my 30 years, almost 30 years of accounting, was the cost method. And then the partial equity method is kind of a hybrid between the two. And so we'll discuss really the differences, and there aren't that many, so don't get too freaked out about that. But I will tell you this, and I've said this before, that the typical way in practice is to really use the initial value method. Now, here's the logic behind this. A parent company, the reason they bought a subsidiary is either vertical integration. They feel like there's going to be some economies of scale. There's some value to them in bringing them and having control over them. But they're also, on an ongoing basis, is going to be need to measure performance. Is that investment that you made performing like you want it to? You're holding people accountable. They're accountable for their bottom line and what they do operationally. The point I want to make is you don't let the accountants create the most important measure or barometer, dashboard, if you will, of how that subsidiary is doing. You're not going. I've never seen this in practice where you use the balance of the investment account that the accountants are carrying on the general ledger. You don't say, okay, the investment account has gone up or down, and therefore you get no bonuses this year, Mr. Subsidiary. I mean, that's not going to happen. You're using all other kinds of metrics, operational metrics, that accounting really doesn't have that much to do with. So don't get caught up. I don't want to slam the authors because this is an excellent textbook, but they talk about, they found a couple of examples of people in the real world who say, yes, we use the equity method, full equity method, for our subsidiaries because we feel like that's a way to measure them, and that's really not prevalent. So just a word there that just to know that you'll expect to see, and I'm going to test you mainly on initial value because that's what's more common. Now, the comparison of the internal reporting of those methods. Here's a nice slide. You may want to print this out but at least keep it handy on juxtaposing the three different methods: equity, cost, and partial equity. Under equity, you know this, you're going to continually adjust it to reflect that mirror image, if you will, of what's going on with that subsidiary. So it's a full accrual basis. You're going to amortize and do those other adjustments and everything. The initial value method, you'll notice this in the problems we're going to work, is you're on the initial value, which is called the cost method, because that investment that you have on your general ledger, the thing that you recorded on your GL when you made that transaction and credited cash or credited notes payable or credited stock, whatever it is you gave up to buy that investment, that is still going to remain at that legacy old value on the date you bought it. So you're going to know that that's what's happening when 3 years down the line you still have that same value. Well, obviously, then you just continue to use the initial value method like most of the other people in the United States. So, and then partial equity is the hybrid. You accrue income as earned, but no other adjustments, meaning that you're going to handle the dividends the same as you do here, and so forth. So again, let's get into this, and it'll make sense to you. The advantages, again, you're getting a true representation of consolidated figures. I don't think necessarily that the equity method makes the consolidation any easier. In fact, my opinion is it makes it a little more difficult because normally in consolidating, again, those entries aren't being made to your general ledger. What you're doing is you're making them off the general ledger on some other system. Typically it's spreadsheets or something like Hyperion or another custom program. And believe me, you are keeping a legacy database, if you will, files, folders, to keep track of what's been going on relative to that investment. And so then when you get out dust off the workbook and get ready to do your consolidation every quarter, you know how to bring it forward. And so you do have that legacy file. I do think the cost method is easy to apply, and that's why most people use it. And partial equity method, and it's approximating the consolidated figures, but again, it doesn't make the consolidation really that much, if any, easier. I think a little more difficult. So the important thing for you to know is that there's no effect on the resulting consolidated financials, meaning that at the end game, when you present your consolidated income statement, balance sheet, and statement of cash flows, you're going to get to the same answer, okay? And the investment is going to get eliminated to zero regardless of which of the three methods you have chosen to use in your consolidation. So don't get tripped up on that. You're going to get to the same end result regardless of which one. And they talk about the distinct procedures are different. We'll see that in just a second. Okay, so under the equity method, and there is a separate video that you'll see where we apply the equity method, and you're going to adjust that investment account that you have on your books in the subsidiary for the dividends earned, and of course the dividends that the subsidiary pays to the parent. Those serve to reduce the investment. And as the subsidiary earns income, that serves to increase the investment. This is all stuff you learned in Chapter 1. Okay, and you also this fair market value adjustments is really talking about the expense amortization, excess expense amortization that's going on. Okay. Worksheet entries in your textbook, they give this SAID, S-A-I-D with the E on the end of it. They use this as standard nomenclature throughout the book. Now, I'm not going to be a stickler on this. To me, and you'll hear me say this in the lecture, and I think I really say it in Chapter 4. In Chapter 3, I think I do follow this naming convention, but know this, in reality, the important thing is to keep your cross-references, define what this is as you do your cross-references, and you'll see this in the spreadsheet where I'm putting a cross-reference column, because you have to keep track, make sure your debits are equaling your credits, and make sure that you're being complete in getting all these entries done. So again, the book defines these as what the S is doing. So know this, the first thing that you do is you take care of that. You're trying to get that investment account adjusted down to zero, because again, you put it on your general ledger, and then when you present your consolidation, you're not going to show a balance in that investment account. You're going to get it down to zero. And how do you eliminate that? Well, you eliminate it against the stockholders' equity accounts that you, for the subsidiary, okay, you're buying up either 80% or 100% of the stock of the subsidiary. That stock is not going to be presented on the consolidated statement. So you're going to get rid of that, and it's going to go against, you're going to debit the stock of the subsidiary on your worksheet, and you will credit the investment that your parent has in that subsidiary. uh, 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 Journal entry A, the way we label A as a cross-reference in the book, is the allocation of those fair value adjustments that you're going to do. So you bought a business and you bought all the stock of that business. Well, the underlying assets that that business owned, those are probably lower than what their true market value is. And so you're going to, most of the time, have an upward adjustment to those assets that you're going to then have as your new basis, that over here on this little worksheet that you're going to keep in your legacy file, you're going to handle the amortization of that. But don't confuse, I should say, depreciation, because I don't want to get confused with this letter A. A stands for allocations of that excess fair market value. Now, letter I for this entry on your consolidation worksheet is to eliminate the subsidiary income that's earned by the parent. Now, as you might guess, this is going to be needed when you're under the equity method. Okay, you're not going to need this when you're under the initial value method, because you have not been adjusting your investment for the underlying earnings of the subsidiary. Letter D is going to handle that dividend account if the subsidiary is paying dividends. Now, the way letter D, journal entry D, is handled, and again, don't get confused. When I say journal entry, when you're doing a consolidation, that is simply a consolidation journal entry. You're not putting it on your general ledger. I know I sound like a broken record, but when you get into your practice and somebody asks you to start working on a consolidation, I want you to know this, so that they know that you had a good learning experience in your advanced accounting course. So this dividend account, you're going to, if you've been under full equity, you're going to have to kind of put that back into the investment account and handle that then on the way you recorded on your equity in your equity section of the balance sheet. So you'll see this on the video, so don't get scared about it. And then letter E is that the excess amortization expenses. E stands for expenses, and I should also say depreciation expenses, because you're going to allocate upward to the market value, and of course then that's going to cause you some extra depreciation or amortization. So hopefully we spent a lot of time on this slide, and hopefully it makes sense to you. And again, it's covered very, very well in your textbook. Okay, applying the initial value method, we have a separate video that shows this, and you're going to know that you used the initial value method when you look at 3 years down the road and you look at that investment in subsidiary account. It's the exact same balance that it was 3 years before when you bought the subsidiary, bought all the stock of the subsidiary, and there it sits. It's still the same amount. Okay, and obviously the accounts that you're going to do your adjustments are going to differ. And of course, points 1 and 2, we really have already made the adjustments for current year income and dividends paid, or amortization of purchase price allocations. Yeah, you don't have to, for the current year income, dividends paid, you're not going to record those in the investment account because you didn't put them in there on your general ledger. So, and then the dividends received are recorded as dividend revenues. So you're going to see in the video lecture for the problem how you handle that. Again, you're going to have to adjust for it on that consolidation, but it's just going to be different accounts than you would have done under the equity method. Okay, so there's our S, A, I, and D and E, those standard entries that you have to make when you do your consolidated financials. And Again, they're saying that entry S, which is your stock elimination against the investment, that's the same under both method. Entry A is the same because your allocations of those fair market values. And we can jump down, and entry E, which was your excess expense amortization, that's going to be the same. So the only two different things are going to be that I and D, which is basically how you are handling the dividend income. And because you handled it differently under the initial value method, you really don't have to do an entry D where you're taking dividends against the investment account. Okay, in partial equity, I don't have never known in practice anybody that really uses this, but again, you get to have a slight difference in I and D, and S, A, and E. Those standard entries are going to be the same. So again, these three entries are the same regardless of which of the three choices, which was either, remember, it was full equity, partial equity, or initial value, which is also called cost. So regardless of those entries, S, A, and E are going to be the same. I and D are the ones that are slightly different. And that's what I just said. So you've got two entries that you make, the accrual of the income and the receipt of dividends. That's those two entries that are going to be different. And then you can say, now the thing is, the investment account that you're carrying on your general ledger, and of course in the income account balances, which is, either you're recognizing this equity income of the subsidiary, or if you're under the initial cost method, you're not doing that, and you're just going to record the dividend as dividend income. That's what you have to deal with, depending on which method you use. So now this is not a ding against the initial value or partial equity. It sounds a little bit negative here, and they say, oh, neither one provides a full accrual basis. And you may say, wait, you have to be on a full accrual. We aren't cash basis accountants here. GAAP requires full accrual, but again, this is the way you present the consolidated statements. So all you do is you're saying, because I know that on the consolidation presentation, and because I haven't been, on an ongoing basis, really tweaking this investment in subsidiary account for all of that underlying earnings of my subsidiary, and I didn't increase it for that, and so forth. That's not a bad thing. So it's not like you're violating GAAP, because you're going to get to the same end result in eliminating that income account, or excuse me, eliminating the investment account. So the initial value method uses cash basis, which is a good thing, actually. So, I think it simplifies the world for you. And partial equity is only partially accrues as subsidiary income. Okay. And of course, then it's going to require different worksheet adjustments. Now, the standard entries S, A, I, D, and E. You also have an intercompany. If you have an intercompany debt or receivables, you have to eliminate that with entry P. Now, I can tell you this: there is not a situation I have ever seen where you don't have intercompany receivables and payables. And most of the time in practice, what you're going to find is that it is one account on every entity's books. So, I'm the parent company and I'll have one account. It's not like I have an intercompany receivable and then down on my liabilities I have an intercompany payable. And let me explain the logic of that. What you want to do is have one account. Let's just put it in the assets section. So in your numbering scheme, and you may or may not know this, hopefully you got it in your intermediate accounting, the numbering scheme of a typical general ledger will have any account number beginning with 1 is typically an asset. If it begins with a 2, it's a liability. Many times a 3 then would be an equity. Then maybe you start with revenues as a 4. Sometimes I've seen 2 can be both liabilities and equity, and your revenues begin, the numbering scheme begins with a 3, and expenses begin with a 4, and so forth. And you can see the pattern there, so that immediately if somebody quotes an account number, you think, oh, that must be an asset because it starts with a 1. It may be 10 digits long, and all these other accounting unit identifiers and all that complexity, but at least if you know it begins with a 1, it's an asset. Now, the point I'm making is that you often will have an account beginning with the number 1, and it's called intercompany receivable / payable. Now, depending on whether it is a debit or a credit balance on the entity that has that account, that determines whether at that point in time it's an asset or liability. Okay? The point is, those accounts all strung across, when you do your consolidation, those accounts, guess what, are going to net to zero, because it's the yin and the yang. If you have, if one of the entities in the consolidated group, and you can have consolidated groups that consist of 40 different companies, and if one of them has a debit balance or a debit entry that it made in its intercompany receivable payable, then there better be another entity that made a corresponding credit. And so I'll drill that point home in a later chapter, but I just want to reinforce it right now, or make it right now, that this intercompany stuff has to get eliminated. And sometimes there's a formal, a debt instrument or something, a loan that's been made between the two entities, and that's what they're really talking about in the chapter. Okay? Now, here's the point about the investment account. No matter which method, which of your three methods, which were full equity, partial equity, or initial value, no matter which method the parent chooses, the consolidated totals are all the same. What is the consolidated total? Well, you should know by now, because you've heard me say it. The consolidated total of the investment in subsidiary account is zero. Okay, so you're going to get to the same answer regardless. Goodwill. ASC, Accounting Standards Codification. You should know what ASC stands for. Hopefully you had that in your intermediate. And of course you've got all these different topics, and topic 350 deals with intangibles, goodwill, and other. Now, this just to let you know, in the program with Cal Baptist, we have an access code. I'm going to be giving that to you because you're going to have a small research project that you need to do, and so then you'll be able to get in to the FASB website and look at these, look at the codification of GAAP. And go to that topic and read all the wonderful explanations and guidance that there is, and be thankful that now, as you're taking an accounting program at this point in our evolution of accounting. I don't like that word necessarily, our development of accounting. Beforehand, you did not have a nice all in one place codification. It was just an amalgamation of stuff from different promulgating bodies, some of which have been long gone, but that was still considered GAAP. And so now what's happened is all that's been brought together. So when you look at that, that's a background on codification. It happened, I want to say about 4 years ago, maybe a little longer, but anyway, that's where all the standards are now in nice one neat place. And now, what happens? What does GAAP require relative to goodwill? I can tell you way back when I used to do consolidations, is goodwill was amortized, and so now we don't amortize goodwill. It is actually tested for impairment, and it's going to remain unchanged. Now, what about goodwill? Well, is goodwill like the account when you record the investment in subsidiary? Do you really record goodwill on your general ledger? The answer to that is no, because goodwill is a result of bringing together into this consolidated reporting entity you're going to do this on your spreadsheets or on Hyperion or whatever your software is. That's when you're going to quote unquote record goodwill. Now, of course, you'll keep it on your books as in terms of a legacy file or somewhere, and you know what that goodwill is when you initially bought that business, that subsidiary. How much did you allocate toward goodwill? And you can see on our video lecture how we go through a process of allocating the goodwill, or what it is, or calculating what it is when we first bought the business. So it's going to remain unchanged when you do your consolidated entries until one of these things happen, until you sell all or part of the subsidiary. When you do that, then you're going to have to take a piece of goodwill with it, and that is going to go with the sale. Or there's been some kind of permanent decline in value, and then we're going to have to test for impairment and then record that loss if the item is impaired. Now, again, they're saying the term record. You're not going to put that on your GL, but you're going to show it on your consolidated financial statements in the period in which that happens, that impairment occurs. There's a two-step test. Step one is you're going to say, I'm going to take the total fair value of this subsidiary entity, this reporting entity, and it's going to include whatever you've allocated to that subsidiary as goodwill. In other words, it's going to say, what I paid for this entity, and then say what's the carrying value of that, including the goodwill of that reporting unit. The carrying value is the net book value when you've already allocated up your assets, and you of course maybe have been depreciating them. We're going to talk about in chapter 4 what happens when you're 3 years down the road. And then you're going to say, does the fair value of the reporting unit exceed the carrying value? Carrying value is what you really, the accounting value you have on it, and now the fair value is what is it really worth. Now, unless that reporting entity, unless there's some measurement looking at a similar company in the same industry, same size, but the fair value, I can tell you, is typically going to be a discounted present value analysis. And so you'll look at the cash flows that entity is giving over time. Say push it out to 10 years, what those estimated future cash flows are, and you'll discount it to present value, and you'll say that number that I get, that present value of future cash flows discounted for some risk-adjusted rate of return, that number, how does that compare to the accounting consolidated value on that entity? And that's when you're going to say, if the fair value is more, no big deal. Goodwill's not impaired. Go to the house, go home, have dinner. If it is less than, now you've got another step to do. And let's talk about what that step is. So this no answer to this question is, does the fair value, whatever you assigned as fair value, the discounted future cash flows, how does that compare to that accounting value? Now we're saying that it looks like we're going to do this second step now. So the implied value of goodwill is calculated similar to that initial determination. So what do? We say, let's allocate that fair value across the identified assets and liabilities, and then subtract the fair value of those net assets, assets minus liabilities, from the fair value of the reporting unit. This is going to be what the implied goodwill is. Now, how does implied goodwill compare to the recorded goodwill that's on the books? And if the implied value is, I'm sorry, this is the implied value. They're saying using quoted market price, similar business, or present value future cash flows. That's the one I talked about. That's the most common. And so, is that implied value less than the recorded goodwill? Again, what you're keeping in your legacy file as your goodwill amount. And if it's no, then you're done. No loss to record. If that answer is yes, then you do have an impairment loss, and it's recorded for the excess of the carrying value over the implied fair value. Now, where does that loss go? It goes on, in the period that it happened, it goes on the consolidated statements, okay, as a loss in that period, and now you have just adjusted your carrying value of goodwill. So the next year, let's say there's another thing that happens next year, and you call into question the value of that subsidiary. And so then you've got a new value in goodwill, right? You just wrote some of it down the prior year in your consolidation. So now that's the new basis of goodwill that you're going to record in your books, or you're going to carry in your books, excuse me. This is a little juxtaposition of U.S. GAAP and International Financial Reporting Standards, IFRS, and there's a slight difference. Use a one-step process in IFRS. I'm not going to really hold you to this, and it's not. I can tell you right now, I don't test this specifically on the test, but your book does a good job talking about that. And you'll notice too, there's a little more over time. There's more convergence, coming together between what is in U.S. GAAP, Generally Accepted Accounting Principles, and what's under the IFRS. There aren't that many differences. Other intangibles. What are we talking about with other intangibles? Those can be things like customer lists, and they could be trademarks, patents. There's many different things that you have. The book does a good job of listing some of those. Now, the tricky part is, and the difference between the word indefinite. Indefinite doesn't mean infinite. infinite versus finite. Infinite means, remember from mathematics and calculus, it goes on into perpetuity. There's no end to it, infinity. But indefinite does not mean infinite. It just means you really can't determine what that life is, or you can't logically put a life on that. Now, patents, different things. The book even mentions like a database. A database is, some software that, because it's a wonderful, software they've created, and maybe they just expensed all the costs that it took to create this, but it has value, and clearly you could maybe market that. Well, what is the life of that? And if you really can't come to a logical conclusion on what that life is, then you're just going to consider it indefinite, and you're going to have to go through a similar exercise on looking at impairment of that indefinite lived intangible asset. Okay. Now, contingent consideration, what that means is you're not just writing a check, doing a wire transfer for the entire purchase price of the subsidiary. If you're buying, say, 100% of the stock or 90% of the stock, sometimes it's very easy to say, here's the total amount of consideration that I'm giving to buy this investment. But you may have an additional piece of that that says it's going to be contingent upon certain things happening, certain hurdles being met. Maybe as a buyer of the subsidiary, you're not all that 100% confident that it's going to achieve certain measurement goals and performance goals, and so you're not wanting to give up everything right now. You're going to say, I'm going to hold back a little bit and make that contingent upon the achievement of certain events. So what you have to do is you have to place a probability on that happening, of it achieving that, and say it's a 70% probability, and then you go ahead and assign a value to it, and then carry that liability, and it's going to be continue to be measured at its fair value. What would cause a difference in the fair value? Well, a change in what your probability of what it is you think is going to happen. That will cause a change in fair value, and then adjust it in your income account. And remember, the thing that you do record in the parents' books, on the parents' general ledgers, you do record that investment account, because you're having to say, I'm giving up consideration to buy this subsidiary, so I'm going to be debiting this investment. I'm going to credit whatever it is I'm giving up. Are you giving up stock? Are you giving up cash? What is it? And some of that piece that you're giving up might be contingent. It's a liability. You're going to owe it, maybe. I mean, hope. And it depends on stuff happening. So that's what we're talking about there. And if the contingency is a stock payment, that's part of equity, not a liability. Oh, I'm sorry, and you don't remeasure it. Fair value is another key point there. Okay. Push down accounting. Push down accounting simply means you're pushing it down to that subsidiary general ledger, and that what the subsidiary, I shouldn't have said general ledger, pardon me, what that subsidiary would record or would show on its financial statements as a separate entity. And what we're really getting at is, are we talking about, and here it says generally limited for external reporting, but increasingly popular internally. Well, if you're going to do it internally, then what that really signifies is you're putting it on the subsidiary's GL. But now the reason there's a simplification for the consolidation is you're taking those values, those fair value allocations. Remember, that's one of those entries we had to do. That was entry A in the SAIDE listing of entries that are made on the consolidated worksheet. That allocation of fair value is what you're going to push down to the subsidiary and have them recorded on their accounting records, and of course then they'll have to amortize. That's going to be their new basis in that asset or liability, and they'll have to then keep their books accordingly with that new basis. And that's why they're talking about maybe a better presentation for internal, what's that business really quote-unquote worth. Okay, in summary, the procedures used to consolidate for a business combination, they are going to be affected by the passage of time, and we're going to see that. We see it in Chapter 3, we see it in Chapter 4, and so and the three values or three methods that you use, initial value, partial equity, and equity, are going to get you the same result, and you do have to test your goodwill for impairment. So I appreciate your time. Hopefully this helped reinforce the critical concepts of theory that were presented in Chapter 3. So again, if you need to go back and reread, do that, and enjoy the problems that are worked out on the two separate videos in Blackboard. Thank you very much.